Have you ever looked at the stock market and just thought, what is going on? How do some people seem to stay so calm and even get rich while everyone else is panicking? Well, today we're going to crack open Benjamin Graham's masterpiece, The Intelligent Investor, and find a real, rational survival guide for the beautiful chaos of Wall Street.
All right, so first things first, we have to be honest about the world we're stepping into. A lot of the time, the stock market feels less like a place for serious business and more like a massive, high-stakes casino. It's all flashing lights and pure adrenaline, where fortunes can be made and lost in the blink of an eye.
And this kind of thinking is what fuels that whole casino vibe. I mean, just listen to this quote from Barbra Streisand. "I can't stand to see red. If I see red, I sell my stocks quickly." That right there is pure, raw emotion. It's a gut reaction, you know? It's not a calculated, logical business decision.
Now, this whole emotional roller coaster hit an absolute fever pitch during the dot-com bubble in the late 90s. Online trading basically turned the market into a national video game. You had TV ads showing people making thousands with just a few clicks. You had so-called analysts making these wild predictions that had absolutely no basis in reality. It got to the point where the price of a stock had nothing to do with the value of the actual company behind it. And you know what happens when a party like that ends, right? The hangover was just brutal. Companies that were darlings of Wall Street went totally bankrupt. We found out about massive accounting fraud, and a lot of the experts had to admit they were just hyping up garbage. And the final bill? A staggering, mind-blowing loss of over $7 trillion. That's trillion with a T. It was a painful, painful lesson that hype is not a strategy. So how do you keep from getting completely burned in a fire like that? Well, Benjamin Graham says it all starts with making one fundamental choice. You have to decide, are you an investor or are you a speculator? Trust me, this distinction is everything.
So what's an investor? Think of an investor like a business analyst or a detective. They couldn't care less about a stock's daily wiggles or its popularity. They dig into the company's assets, its debts, its ability to make money, and they're trying to figure out just one thing. What is this business actually worth? It's all about the facts and the figures. Now, a speculator, they're playing a totally different game. It's basically a game of hot potato. They're not really concerned about the health of the business or its value. Their entire bet is just that somebody else, somewhere down the line, is going to be willing to pay an even higher price. They're focused on the price tag, not the business itself. And as you can see, these two paths are like night and day. The investor thinks like a business owner, focused on long-term value. The speculator is much more like a gambler at the casino, just betting on short-term price swings, totally driven by hype and emotion. They're playing two completely different games on the same field. But here's the thing. According to Graham, deciding you're going to be an investor, that's only half the battle. The other half, the much, much harder half, is winning the battle against the enemy in your own head. And this is one of Graham's most famous and powerful insights. He says it's not the crazy market, it's not the economy, it's not some bad analyst on TV that's going to be your biggest problem. Nope, it's your own psychology, your own emotions, it's you. And you know what? Science totally backs this up. Our brains are literally hardwired to chase trends. When a stock we own goes up, we get a little hit of dopamine. It feels good. And because it feels good, our brain expects it to just keep going up, which can trick us into buying high right when the risk is at its absolute peak. So, how are we supposed to manage these crazy impulses? Well, Graham came up with this brilliant little story to help us out. He wants you to meet your new business partner, the one and only Mr. Market. So here's the setup. Imagine you own part of a business, and your partner is this guy, Mr. Market. And every single day, without fail, he shows up and quotes you a price. He's willing to either buy your shares from you or sell you his shares at that price. He's reliable, but he's also incredibly emotionally unstable. On some days, Mr. Market is on top of the world. He's absolutely euphoric. He's seen the future, and he's convinced your little business is going to take over the universe. On these days, he'll offer to buy your shares for way, way more than they're actually worth. But then there are the other days. On these days, he shows up and he's a total mess. He's completely despondent, convinced the business is doomed and the sky is falling. He's so panicked that he'll offer to sell you his shares for pennies on the dollar, far below what they're truly worth. So, here's the crucial lesson. Mr. Market is there to serve you, not to guide you. You don't have to get swept up in his drama. You can just ignore him. Or even better, you can use his wild mood swings to your advantage. You're in control, not him.
Okay, so if we're not supposed to listen to Mr. Market's daily nonsense, what are we supposed to base our decisions on? This brings us to what Graham says is the single most important idea in all of investing, the margin of safety.
A margin of safety is basically your financial shock absorber. It's the gap between what a business is really worth, its intrinsic value, and the price that emotional Mr. Market is offering it to you for. The bigger that gap, the bigger your cushion, and the safer your investment.
Let me break it down for you. Let's say you've done all your homework, you've run the numbers, and you've determined a business is worth $1 a share. You don't go out and pay $1 for it? No way! You wait until Mr. Market is having one of his bad days and offers it to you for, say, 60 cents. That 40-cent difference, that is your margin of safety. It's your buffer against being wrong or just getting unlucky. And this is the real genius of it. You don't need a crystal ball to predict the future perfectly. The margin of safety protects you from the unknown. Even if your analysis was a little off and the business only turns out to be worth 80 cents instead of $1, you still make money because you were smart enough to buy it at 60. So it really all comes down to the simple but powerful personal vow. Know that you're an investor, not a gambler. Use Mr. Market's mood swings. Don't let them use you. Be the master of your own emotions. And always, always insist on a margin of safety.
And if you can actually do that, if you can live by that creed, something incredible starts to happen. You stop looking at the market's craziness as a threat. Instead, you start to see it for what it is, a giant field of opportunity. Every panic, every mania, it all becomes a chance for you to profit. And ultimately, that's the question Graham leaves us with. The market is always going to be full of foolishness. That's just a given. The only real choice you have to make is, are you going to profit from that folly, or are you going to participate in it?